Well, thank you guys for joining us. This will be uploaded to YouTube hopefully within the next 24 hours. Please check us out there and hit play and share it with your friends and all that kind of good stuff, right? But Omar, over to you. Let's start the fund update.
All right, today, guys, we're going to be talking about seasonality today, and we're going to be talking about what exactly it means to say sell in May and go away. That's a very common theme in the investing world, right? Sell in May and go away. So we're going to be talking about that today, what we're doing in the portfolio, all that good stuff. So the main thing to talk about today, and we try to talk about a different theme every time. Today, like I said, it's going to be about seasonality, okay? What positions we have and what to look out for the next few weeks and actually next few months. Because from now, May 5th, today is May 8th, but from May 5th, roughly to October 26th, the market is generally flattish. And I'm referring to the S&P 500. The NASDAQ is a little bit different, but it's generally flattish. It's not where the bulk of gains are garnered for the year. The majority of the gains are from October to May. So you have to navigate your portfolio a little bit differently in the summer months than you do in the winter months. Okay, so we're going to talk about that in detail month by month. Okay, so we're going to talk about what is seasonal investing. It's one of the three things which differentiate us from everyone else. First one is concentration. We hold 15 positions roughly. The second one is we write puts and calls those positions. And the last one is seasonality. And it's a topical discussion right now because we are entering the end of seasonality, like we talked about, right? So it's different from cyclicality. Cyclicality refers to business cycles. Are we in an economic expansion or contraction, or what are we in exactly? Seasonality can really help us decide when to write calls and puts, okay? And the reality is that you're going to be writing a lot more calls in the summer months because the likelihood of the markets really going a lot higher are not super high, okay? So we want to keep that in mind, but at the same time, we got to keep in mind a couple of things. Is inflation under control? The US presidential election is coming up very soon, 7 months or so. So those are all going to play an important role in how the markets do it. Now, generally speaking, the markets perform pretty well in election years. Now, this year, there's no guarantee that'll happen, but generally speaking, that's what does happen. Good performance, but we're in an interesting economic cycle. And that cycle is inflation going to come down, or is the economy going to get really bad? Now, just anecdotally looking at it, it doesn't look like the economy is doing great, right? You have a lot of problems with the economy. Just, again, this is anecdotal. You look at the number of people who are struggling, the number of bankruptcies, they are high right now. So the reason the central banks increase interest rates is to slow the economy down and therefore bring inflation down. Now, that's been a theme that's been playing out for quite some time now. Inflation has been persistently high because during COVID, governments around the world, central banks around the world, printed up a ton of money. And the classical definition of inflation is too much money chasing too little goods and services. So if you're just able to print money out of thin air, it means that the existing money in circulation is worth less. And that's exactly what happened. If you notice, your purchasing power has gone down, right? Like a loaf of bread costs more, everything costs more, gas costs more, everything costs more. It's because a lot more money was printed. And that led to inflation, because inflation looks at the absolute number. So that's really what's been affecting the economy and the markets. Now, how quickly interest rates come down will be interesting, and that's very good for the way that we invest, especially in technology companies. You want interest rates to be low, but it hasn't happened yet. It was originally supposed to happen, if you look back maybe 6 months ago, 7 months ago, in the spring market, which is where we're in right now, maybe April, May area, but it hasn't happened yet. Now, where it happens and when it happens and how quickly it happens, we don't know. But we do believe that interest rates will be going down because the economy is not in great shape. That's both in Canada and the United States, okay? So you can have a lot of these things that take into account. So let's take a look. Money flow, okay? Seasonality occurs because of money flow, changing market expectations, and a lot of other things, including anticipation and realization cycle, which is an interesting theme. But we consider seasonality to be one of the major inputs. It's like I said, it's one of the three things that differentiate us from everyone else. We really pay attention to seasonality because it means a lot. it means the markets are not going to do particularly well, or have not, excuse me, done particularly well in the summer months. So we're much more inclined to write covered calls, and even that more aggressively. That's the great thing with our strategy. We can continue to make money even if the markets don't perform exceptionally well. Okay. So let's take a look at seasonality in terms of what it means. Okay. So you can see here from now, this is the likelihood of that month being a positive month. So if you look at October, November, December, January, February, March, April, May, those are pretty good months, you know, between 50 to 80% of the time positive, generally well above 50. 50 is a bit of an outlier there. And you can see at the bottom the percentage return in which the S&P 500 closed up. So how much was the S&P 500 up? Now remember, the S&P 500 has gone up on an average of about 11% a year for the last 40 years. Now there's ups and downs, of course, but that's the general overall theme. That's the general overall trend. So let's take a look at where we're entering now. We're entering May. Like we said, the first half of May happens to be pretty good, and the latter half of May happens to be good. So May is positive 75% of the time with an increase of 0.4%. June, you can see, is actually kind of a negative month, 0.1%. Not a huge month, but slightly negative. And then we go to July, which is the best month of the summer. It's positive, or has been positive, 75% of the time with an average gain of 2.4%. So we're going to take that into account. Now, seasonality, again, as you can see, it's not 100%. What you're doing is you're playing odds and probabilities. And that's the great thing when you're writing puts and calls. When you're writing puts and calls, you can write puts close to money, far away from the money. You can write calls close, far to the money. You know, you can really tailor it based upon historical trends. And that's what we're looking at. Now, let's take a look at the last few months before seasonality kicks in again. August, flash, 0.1%. September and October tend to be the worst months, with September being the worst month. So the odds of it finishing positive in September, October, only 60%, with September being a negative 0.6%. And then we hit the good period of year. So the reality is the majority of the gain from the markets come from October, late October to early May. And the rest of the time, it's kind of more flattish in the S&P. Right now, a lot of our companies are domiciled in the NASDAQ. So we're going to take a look at that.
And that's the next slide. Yes.
Yeah, so we're going to take a look at the NASDAQ. Okay, so NASDAQ, let's take a look at NASDAQ. So let's go to the summer months here, and we look at June. You can see June's not a great month, but like I mentioned, July is a pretty good month. August, not bad. 50, it's a coin flip, half-half, 55%, 0.7% positive. And October, 60% time positive with an average gain of 1.6%. But again, as you can see, the majority of the gain comes November, December, January, February, March, and April. And May, sorry. So that's where the majority of the gain comes. And that's really how we have to play and decide where we want to write puts and calls. Like, for example, do we want to be super aggressive writing puts in June? Well, maybe not. Why? We could. July tends to be a positive month, so we could, but June is not a great month. The time that we want to be the most cautious is going to be the end of the summer. At the end of August, going into September, and into the first part of October. Those are the worst periods of the year historically in the markets, in the NASDAQ. So we're going to be cautious. We'll keep a higher cash position at the point in time. We can write puts closer to the money. And in the summer months, like I said, we can write calls, and aggressively too, right? So let's take a look at post-holiday, pre-holiday, Santa Claus, right? We all know those things are coming soon. But what do we expect in May, June, July? Well, May, as you can see, the NASDAQ is on average up 11%, but it tends to be the first few days and a little bit towards the end.
1% there, or 1% for the last 50 years.
Yeah, that's correct. 1%.
Yeah.
Yeah, NASDAQ is up 1%. So the technology sector is the best performing in the last 30 years at 1.6%. June, the NASDAQ is up on average 0.8%. Last 30 years, healthcare was the best performing sector, which we have a company called Eli Lilly in there. July, that tends to be the best month in the summer. So although the summer months are not the best, July happens to be the best. As you can see, the S&P 1.3, NASDAQ 0.9%. And technology, again, best performing sector. Now, going into August, Well, the NASDAQ is on average up 0.3%, but your end of the summer and people are not really interested in the markets. What are they doing? People are vacationing, they're enjoying life, and they're living, okay? Utilities happen to be the best performing sector. And why is that? Because you're going into September and October. So the market tends to get defensive in this period of time. Utilities generally don't fluctuate a whole lot in price, and they have very stable interest because everybody has to pay their utility bills, whether there's a recession, an economic boom, an economic slowdown. It happens to be the best performing sector in August. September. This is the worst month of the year for the markets, okay? So the NASDAQ on average is down 0.9%, and it's, like I said, the worst month of the year. The second worst month of the year is October. Now, it looks a bit misleading because you see the NASDAQ at 0.9%, you see the S&P at 1% gain. Well, if it's the second worst month, how does that make sense? Well, generally, the first half of October is not very good. So you kind of get that bleed from the end of this August all the way to the middle of October. Those are really, that's a really bad patch of the year currently in the market. So what we're going to be doing, and again, it's playing into seasonality, is we want to keep a higher cash position at that point in time and really look to get fully invested or very near fully invested towards the end of October when seasonality kicks back in again. But this year is, like I said, a bit of a wild card year. The US presidential election is in November. Now, November is typically a pretty good month. NASDAQ on average up 1.9%. December up 1.3%. And technology happens to be does really well in November. On average up 2.8%. And, you know, as the alpha portfolio, our alpha portfolio is very much geared towards technology. Utilities happen to be the best performing sector in December. I'm not quite sure why, because utilities generally tend to be defensive. And this is when you have that Santa Claus rally. People are in a jovial mood. Things are good. There's holiday parties going on, et cetera, and people tend to be optimistic about the next year. And there's a lot of spend with different companies towards the end of the year. So, for example, all the companies get their new budgets for the year, how much they're going to allocate towards different sectors. Technology actually does very well in December. So that is what we're going to be doing on the next little while. So think of the summer months as writing a lot of covered calls, closer to the money. And again, because it doesn't generally perform exceptionally well, except for July. And you want to
and I'd add to that on the put side, you know, yeah, we're still going to be active in that realm as well, because we do want to see some if some issuers are trading lower, we might be incentivized to like get into those positions at those potentially depressed prices during the course of the summer if seasonality plays out right now. You know, the market is looking a little bit long in the tooth and is looking for a little bit of direction, which I think, in my opinion, may certainly come from the Fed, with their meetings and what the rhetoric is out of the various leaders' mouths there. But then again, on the put side, yes, we will want to still be active, but potentially go a little bit further out of the money, looking for technical levels that are you know, further away from where the stock is trading at, but based with some support there. If, and this is the big if volatility permits, because right now we're in an environment where you do see a stock market that could potentially be a little bit long in the tooth, but you don't have a lot of volatility to go with it with certain stocks. Some you do, but some you certainly don't. So you do need a certain amount of patience with that. We have been waiting patiently to leg into certain positions that we would like to get into, but you know what, like it's a two-sided coin, isn't it, Omar? It's like, you know, what's the most what's the biggest sign of a stock hitting an all-time high? It's like, well, it already just hit another all-time high, and now it may hit another all-time high. But then the question to each of us is, do you want to be getting into a stock long at an all-time high? And sometimes we have a bit of an unnerving feeling about that. And one input we are using that's kind of giving us that feeling is that, hey, listen, this is a seasonally rough time of year, and we don't know if the stock market is going to, you know, rally right through the summer or not, right? Historically speaking, we see that numbers have been softer in May in terms of the likelihood of the respective index closing higher or lower. And even in May, you're seeing 60% chance. But and you may say, hey, 60% not bad odds. Yeah, you know what? They're not bad odds. But guess what? There's months like November and January which have like a 75 or 85% likelihood in the past 20 odd years for ending their respective month higher. Another complexity which we kind of layer on there, guys, and you and I deal with this on a daily basis, is when we put on a written option position and when it actually expires, right? So it would be lovely if you just had, okay, we put on a position at the beginning of the month that expires on the last trading day of the month, but like, that's a utopia that really doesn't exist. So that is another layer of the onion we need to kind of analyze and get comfortable with. Okay.
Yeah. So the reality of the situation is volatility right now, the VIX index is at around just over 13. We know that the long-term mean is around 16 and has been persistently low for about 6 months since seasonality started last year. Since October 27th of last year, 2023, the stock market has been on a bit of a tear. Not so much in maybe the last 2 or 3 months, but this has driven volatility down. We haven't really had a major pullback yet. Now, volatility did increase about a month ago to around 20, but it's back down to 13. So the point is, if volatility is very low, that means we're not getting paid a whole lot for collecting premium. We're not, because, the fear is low. And you're ending the end of the seasonal period of time. So if you're ending a seasonally unfavorable period of time, along with lower volatility, it doesn't make sense to be super aggressive here. Now, that may not work out in our favor, but historically, that is the direction you want to look at. And volatility, quite frankly, is really low right now. So we've got a large cash position on hand, hopefully waiting for a bit of a pullback here. So let's take a look at our current exposure. What do we have here? Well, we're underexposed when it comes to Alphabet and Amazon. They've run up a bit. We're waiting for them to pull back. So we've got some exposure, but not a huge amount. Apple, again, a little bit of exposure, but not a huge amount. We're waiting for a bit of a pullback. Microsoft, we're starting to get exposed to pretty good here. At half our allocation, roughly a little bit over half. Tesla's one stock that we are almost or are fully exposed to. And the reason for that is Tesla has had a terrible year so far. Terrible. It's down a substantial amount from the beginning of the year, but that's really good for us looking to leg into these positions. Our average price on Tesla is about $190 a share, $189 a share, but we probably collected on average maybe $15 a share. So we're pretty good right now. We've actually made a lot of money on Tesla simply from collecting premium. AMD just reported their earnings last week. They were not the best in a couple of different segments, namely their computer growth, but their GPU growth is phenomenal. And they're competing directly with NVIDIA, okay? Meta's doing great. We have a good amount of exposure. Eli Lilly, we're still a little bit low on Eli Lilly. And again, this is about legging into positions. You don't want to go all in because for us, we just started this fund about 3 months ago. We want to get into these positions, but we want to get them responsibly at a lower price. Now, the markets, if they keep running up, we know the odds are they're going to pull back sometime in the summer with seasonality. So this is when we're looking to get more fully allocated. TSM has had a good year so far this year. Again, we're almost allocated. Same with NVIDIA. Same with Airbnb. We are slightly over allocated on Bitcoin. Hopefully we can average down. And last week we talked about Bitcoin halving and what that generally represents after. How does Bitcoin perform after? Now, Bitcoin is a very speculative asset category. It doesn't have earnings, for example. We've talked about this multiple times. A company in the long term goes up or down based on the amount of money it makes or doesn't make. Well, Bitcoin isn't a company that makes or doesn't make money. It is a commodity. It's a means of transaction. It's a store of value. And with governments around the world printing up a lot of money, we wanted to have a little bit of Bitcoin exposure. But as you can see, it's substantially less than, let's say, Microsoft or Tesla or Apple or Eli Lilly. It's a low number at 3%, but we believe that 3% could do very, very well over time. And lastly, it's Netflix. We don't have any exposure to Netflix right now. We have written some puts on Netflix and collected some good premium, but we're looking for a better entry point as the summer months roll around, okay? Now, just to talk about the fund again, we talk about this every time. It is RSP eligible, TFSA eligible. Here are the fund codes. There's a management fee at 2.5%. It is definitely a higher risk portfolio because these are volatile positions, as you can see from the likes of Tesla and Bitcoin, maybe less so Apple and Microsoft, but generally speaking, it's a volatile portfolio. So if you need that money in the next 6 months or 3 months or a year, it's probably not the right portfolio. But we believe, as David was saying earlier today, there will be a pot of gold at the end of the rainbow. Now we have to wait for that to hit. So that is what we're looking to do. So if you're looking to invest in the fund, please give us a shout. We'd be happy to help you out. And I'll be reaching out to a lot of you guys in the near future. So how much do we have exposed right now? 72%. 72% of the portfolio is exposed either through a long position, which means we own the stock, or we've written a put against it. So if we had to buy something, we had to buy everything right now, it'd be at 72%. That means 28% of the portfolio would be in cash. So we've got a lot of positions available for us to write if the markets pull back in June, as they normally do, in the latter half of May, as they normally do, okay? We have a lot of covered calls in place right now, again, because May and June are not very good months. So we've written tons of covered calls, tons of them actually, okay? Exposure as a percentage of AUM, this is the actual how much stock we own. So not counting puts, but just how much stock we own. We own 44% in actual stock. We've collected about 5.4% in premiums. Now, a lot of that still has yet to decay, but that has been a really good start for us. And percentage collected as a percentage of premium, which exposure, excuse me. So since we've only exposed 72% of the portfolio, if you count that 5.4% only against 72%, we're actually at 7.5%. The average duration right now is about 26 days. You know, we like to keep that to 30 days and less. So we're at 26 days. Now, this may increase or decrease slightly based on seasonality, but so far it's been a really good start to the portfolio. We continue to collect a lot of premiums, and we're going to continue to do so over the summer months. So like I said, overall, May tends to be a volatile month. First half of May is pretty good. Second half, the latter bit is pretty good. June is not very good. And the markets this year are simply looking for rate cuts. In Canada and the US, we're looking, when are these rate cuts going to happen? Are they going to happen sooner or later? Nobody really knows that yet. Now, just again, anecdotally looking at it, I would think that rate cuts are probably not too far on the horizon because the economy doesn't seem to be doing all that well. And we've gotten some recent job data in the States that shows the labor market may be slowing down a decent amount. And the wild card out of all this stuff is the election coming up in November. Now, if the Democrats are in a position where the economy is doing poorly, the stock market is doing poorly, you know, that's really going to hinder their chances for re-election. Mr. Biden, I mean. So they're going to do their best to make sure the markets are performing well and the economy is doing well. So it's really the kind of the wild card. Every 4 years, you get this wild card. You don't know who's going to win and who doesn't. This one might be a bit bigger than the last one because, you know, oftentimes you have a two-term president. But this time, it looks like the Republicans are in the lead, and people might want a bit of a change. And the Democrats' best hope of securing re-election is to have a booming economy and lower inflation and a brighter outlook. So they're going to do their best to get there, and that could be very good for the markets, okay? Now, if you want to contact myself or Matthew, here's our contact information. Please do contact us. I will be reaching out to a lot of you guys in the near future to get you to invest in the portfolio so that we can enjoy the ride together over the next number of years. We are very, very confident on our portfolio of how it's going to perform over the next number of years ahead. We've collected a ton of premiums so far. Even though the market really hasn't done all that great since the majority of our money came into February and March, the markets haven't done really well since then, but we have done very well. So if you want to look at investing in the portfolio, please let us know. I want to turn over to Dave and see if Dave has any comments.
Well, I almost need a glass of water so that I can rinse my throat because I haven't spoken in like a half an hour and my throat is parched and dry. No, actually, I have very little to add. You know, every year is challenging in the stock market. Every year presents its own unique experiences. There are things that ebb and flow. Issues like seasonality are not, they are real. That doesn't mean that they go exactly according to plan. Nothing goes exactly according to plan. But again, when you take a look at what's going on, the stock market, um, the US is, it's weakened, but it hasn't collapsed, which I think is positive, because that can lead to a recession, which can easily cause a lot of the stocks to come off significantly. But it's certainly it's the temperature underneath the boiling water, as we would call it, has definitely cooled a bit, and I think that's good. So, I don't think anyone a year ago, when the interest rates started going up in April of 2022, if you told them that they were going to be hitting 5.5%, everyone would have predicted a recession. Then when we got to that point and there wasn't a recession, they said, there's no way we're not going to have a recession. They can't do a soft landing. Well, here we are. We seem to be in the midst of a soft landing. Inflation has been coming down. Yes, there's some elements of intransitivity. And I think part of it, as I've mentioned before in the past, is related to supply chain issues. When you deindustrialize or onshore your production facilities, that's going to create some problems. And of course, we've got geopolitical issues that kind of affect our supply chains. All that being said, we're all moving in the right way. And yeah, there's a reason why VIX, as Omar pointed out, is only 13.5 as opposed to its more natural 16%. We will get there. The one thing I can assure you is we are going to come in someday and we're going to see VIX well over 25. 30, don't know why, don't know when, and I have no idea what's going to cause it. But right now, everything is going smoothly. And the big thing is just to keep reaching out, getting people in, and sitting back and enjoying the market. That's it. I have nothing really to add to what Omar and Matthew have been saying today.
Yeah, thank you, David. It's for us, it's a very long-term picture here. We're gonna wait for our themes to play out. We've talked about the themes, a different theme during every one of these fund update calls. Whether it be cloud computing, electric vehicles, autonomous driving, Bitcoin. We've talked about various themes. These themes are going to play out over a long-term period. In the short run, there'll be a lot of different challenges and things, obstacles to overcome. But the good thing with us, with our strategy, is we're able to collect some pretty good premiums while we're waiting around. That's what we've done so far. And hopefully we continue that in the near future. Matthew, anything to add here?
Yeah, so I mean, there's a lot of talk of seasonality this call, and I think rightfully so. Like, this is the whole kind of quote unquote dreaded time of year. But at the end of the day, we have developed this approach using, as Omar said, kind of three pillars. One is seasonality, another reason is concentration, another reason is written options, and they're all chosen for very relevant reasons, and reasons that have empirical evidence supporting them. Right now, that's because that's the case doesn't mean it supports it all the time, and our job is to navigate, even though we have those three pillars, is to navigate around them during these time of year and other times of the year where there might be a sense of irrational exuberance, or overselling in the market, to say, okay, can we cut through the noise and figure out what's really going on here? And that's exactly what we're doing, right? So seasonality, yes, is it an important part of our decision-making process? Yes, it is. However, it is all but one input into the decision-making part of the process. I would say that by like over and above everything else is the quality of the underlying exposure that we're seeking. That is the main driving force in what we're looking at, right? Like, if we didn't, like on this page here, if we didn't believe and had a thesis about each and every one of these stocks, they simply wouldn't be here, right? And Danielle, our research analyst, does an awesome job on keeping us informed and writing research reports. And I believe all, if not all of you are receiving those reports. And if you're not, let us know. We'd be happy to share them with you. And yeah, so we do if you just want to go back to the page one more, yeah, you know, we can certainly send those to you. So there's a good rhyme and reason why we're investing these, and this is the main thing. It's like, you know, you hear options kind of seminars. Oh yeah, you know, you write a put, make sure you want to own the stock, and then you do this, and this. It's like, well, hold on a second. Let's go back to make sure you want to own the stock. And these are stocks that we actually do want to own for a good reason at the moment, right? And that's the foundation. The other foundations, the other things that build on this, they support what we're doing here, right? And seasonality is one of them. So don't get too hung up on this. It is important, but there are other inputs as well. And hey, you know what? In September, when we look back at the summer, if we see this a rally or not, suddenly everyone's look back crystal ball will be crystal clear. But you know, unfortunately, that doesn't really count.
Excellent.
That's all.
Okay, so guys, that's it for today's fund update call. Really want to thank you guys for attending. As always, it'll be posted up to YouTube. Please share with friends and family, and we'll be in touch very soon. Have yourselves a wonderful evening.
Thank you.
Bye.
Bye.
Yeah, bye-bye.